What's up, everyone? It's Kev from Severe Trading, and today we're going to go over this week's recap, especially today. Today's Friday. It's Friday evening right now on April 5th, 2024. Let me get that right. That's right. And today was a really fucking crazy day. Like a really crazy day. A really crazy way to end the week. So I started trading this week with Capital Markets Elite Group we have right here. I'm not going to show the underside because it shows my balances and everything. However, using Capital Markets Elite Group, it's a broker, which is this screen, and this screen right here. This broker allows me to leverage using minimal capital. So this is how traders get around that PDT rule, which can be a bitch if you know what I'm talking about. So today, Friday morning, this week's mission, I started trading again this week, and my main mission I realized is that I have to survive. It's not about winning. Like, yes, the goal is to win, but you can't win. You can't succeed if you can't survive the market cycles, the economic cycles. You can't survive all the ups and downs. It's very easy for everybody to make money when everything's going zoom, zoom, all these shit coins, everybody can make money. That's not the hard part. The hard part is to be able to consistently make money through the good times, the bad times, the mid times, the shitty times, everything. And to be able to do that, we first have to learn how to survive, and that's where I've been fucking up. I know how to win, but I have trouble surviving the shifts between market cycles as stocks start shooting up and they start slowing down, they get colder, they get harder to trade, then they shoot up again, and we have to first survive. So we started off this week trading very minimally. We ended up coming into Friday around $50 profit. Majority of it came from Monday. I think I took a $10 loss on Tuesday. Wednesday I didn't trade. Thursday I think I didn't even trade either. Maybe I did. But today was interesting because today we lost $500. I lost $500. And I also remade those $500. Well, I lost $600 and then I made back the $600. But the interesting part about this wasn't the fact that I lost nor I made the $600. When I lost the $600, I lost them using way too much capital. I think I used double the original capital that I had. I used money that the broker was borrowing, and I still lost. However, when I made the $600, I did it only using half of my original capital. I didn't even exceed my original capital, meaning I still had extra left money I could use, which I didn't. If that makes sense. So we're going to follow right now. So to put it into perspective, my total $600 loss was using 200% of my capital. This is able because the broker here allows 1-to-6 buying power. One of my rules is to never exceed my 1-to-1 buying power, never exceed the amount of capital that I myself have in this account. However, today I failed to neglect that as the stock was actually more expensive, and I forgot to. I think I overlooked it. So the stock I'm talking about right now is GCTS. So GCTS was trading around $11 a share. Trading around $11 a share pre-market, so we already know we're going to have a harder time making moves. So GCTS was where I lost the $600. Majority of it came from buying at this peak where I instantly got stopped out. I was like, okay, whatever. I normally stop out, but here I had 200 shares, which was not a smart move considering the stock was $12, meaning I had a total of $2,400 in this account. Meaning I was using more money than I had in my account. So this crashed and then this crashed, and then I accepted my fate around here. So I notice how I used number one on the list of why this was a shitty trade to make was that, well, my first trade. Let's go over my first trade. We have all my trades right here, as we can see. All my trades are right here. For those who don't believe me, these are all my trades. MDIA, which was the one where I made the money. You can see I bought, which is in blue. I bought 100 shares quantity at 2.92. Another 100 shares at 3.15, totaling 200 shares at an average of 3.03. That's $3.03 a share. Now, keep in mind my sell price was right at 6, a concurrent double of sold my 200 shares in an hour and 13 minutes after, right? Hour and 13, 40, 50, yeah. hour and 16 minutes after, give or take. But how did I sell at the current 6? Well, I had a limit order. I put a limit order right here, where I put a limit order, I put my price, and then, yeah, my order went through. And I'm going to go over it eventually. So my point that I'm trying to make is that I lost $600 on a shitty stock. The reason that I had to have so much money in it was, number one, poor risk management, but it really revolves around two things: my poor risk management and the fact that I shouldn't even have been in the stock in the first place, because it just wasn't really, it wasn't that good of a stock. It wasn't that good of a quality. It was already above $10 a share, which I don't like seeing. It was way too volatile was my main red flag. I mean, in a single minute, this stock dropped, and I think I was actually in this position. I stopped out. This was at 829, 828. Stopped out at 830. So I actually stopped out at this position, only had 100 shares, which was still too much, but not bad. But still not the best. And the stock crashed. Within a minute, it goes from 12.4 all the way down, reaches a low of 10.8. For perspective, if you have 1,000 shares, if you have 100 shares, you have a total of $1,246, wiped out all the way to $1,080, meaning you just lost around $200 in a matter of a minute. That is equal 1,200 minus 200. You're wiping out more than around 10% of your entire account in a matter of a minute. So after me seeing that, I should have understood that this stock is either number one, not for me, or we're going to enter with minimum size at max 25 shares per entry, max total of 50 shares per entire position, which I did not follow that rule. Why did I not follow that rule? Well, it kept dicking me around. It kept fucking with me. It kept messing with me. It jumped right here, came back down, and jumped right here, and then here it took me out. So yeah, stopped where? Stopped 8:30 at 8:30. Okay, 8:30 flop again over here at top, entered around this area, flop. It was just at this. I'm looking back at this, and I understand that I was trading based off of no significant levels. Maybe if I had bought this level at the support, maybe around 11 max, could have sold at 12. This is the only concurrent. This is the only area. This buy here and sell at the resistance would have been a smart move. However, buy at 11. My stop is at 10.14. My profit level is at 12.5. That leaves me with a profit ratio of 1 to 5. One risk with 1 to 5 reward. That's still not good. That's not good. For the amount of money we're risking, this stock is just too volatile. And it was proved later on here, which I should have never had 200 shares in the first place. And I think the reason I had 200 shares was because I had already accumulated a lot of losses, which equal to around $75 in losses. So it was going to be my biggest red day. So to make up for it, I did that. And I shouldn't have done it. That was a pretty bad mistake. I at least accepted my consequences and sold here, and I was like, fuck. But then, no, yeah, and if I hadn't sold it, I would have, my entire account would have been wiped out, kicked off the broker within the same day. Wouldn't have lasted 5 days. Wouldn't have survived. Main mission, survive. So that happened. So I moved my attention to MDIA. Now, the reason I liked MDIA much more, and there is also an element to this which I did not predict. Okay, we have to be conscious. I have to be conscious of that. All right, I'm not a mastermind. I can have some levels of experience, but I'm also not a mastermind. There is some levels of randomness to this, and I'm gonna say what I mean by that. So we have pre-market high at 4.76. We see it here. I don't know. I think I drew it gray because it was messing me up in real time as I was making my diagrams. Okay. So pre-5 minute, we have real pre-market thing here, pre-market high here, right? Stock dozes off, but first off, we have to first evaluate whether the stock is one of quality, which, okay, that's one thing I missed. With GCTS, we had a couple red flags with GCTS, and let me go over those, why those were shitty trades. So for those who understand that it's not really just about the strategy, the actual stock itself also takes into account. So number one, I was trading pre-market, right? We know that trading pre-market is more volatile and there's less volume backed by it. It's also, you get worse entries The breakouts sometimes don't tend to either break out way too fast or they just don't break out at all. It's a little bit less predictable. There's less volume. I've had very little positive results trading pre-market. That's for sure. So it's much more predictable in the open market, as you're about to find out. So it fucked me over 5 times, and I still went in for a 6th trade, which was the big one. So I didn't learn my lesson, right? Number 3, it had no float rotation. Now, what do we mean by that? So as we see here, GCTS, there are a total of 43 million shares in the open market. These are 43 million shares in the open market, right? This excludes inside buyers, CEOs, peoples like that. This excludes those shares, right? This is just the float. So, and how many of those shares have been traded today? 28, right? So if we go on a calculator and we go 43 million, we have a total of 43 million shares, right? Divided by, what do we have? 28 million shares, give or take. We have a total of 1.53. Wait, no, I did the math wrong. Because fuck, it was how many times does the volume Oh, okay, no, I'm tripping. I'm tripping. It's the other way around. It's the other way around. It's the other way around because 28 million divided by 43 million equals 0.65. So we have 0.65 float rotation. With float is our shares. We have 43 million shares, right? So our volume tells us how many of those shares have been traded, right? Our goal is to see that the number, this volume, be bigger than the shares volume. That tells us that even though we have this amount of shares, that quantity of shares has been rotated this many times. So this hasn't even had a full rotation of shares, right? Float rotation is the stock is being traded too fast for the amount of total supply that it has. It's being flipped over too many times. When you try to flip a house, no, wait, not maybe. When a stock gets flipped over too many times, the price goes parabolic. So we're gonna give another example. We're gonna say, oh yeah, and also this stock. Just to conclude on the stock, it was too volatile. It was above $10, which is okay. 10 to 20, I can still trade, but it was just way too volatile, and I also surpassed my budget of 1-to-1, which we already covered. So let's cover MDIA, for example, right? MDIA, before the stock even opens on the day, right? By the time I open up my screens, we're over here, give or take. This is what I'm looking at my screen as soon as I open this right here, because it halted right there. So this is right where it halted. So this is kind of my screen basically. We're gonna ignore this 15-minute chart for now. Okay, so this is what I'm looking at. So let's take a look at this, right? Shares, we have 26 million. So we have our volume, which is again 118 million divided by 26 million. So you see here we have a float rotation of 4.5 times. What does that mean? Our float, which is our total of 26 million shares, has been rotated 4 times. Meaning that there's so much volume going around that it surpasses the limit of shares on the market. An example would be, let's say I have 30 pencils, right? And the volume of the day of how many pencil transactions there were today, because people were buying and selling, but people wanted the pencils, right? Because that's the reason there was movement of pencils in the first place, because people wanted the pencils. If nobody wants a pencil, there would be no transaction of pencils. So the pencil was being transacted all day long, a total of 120 times. If I had 30 pencils, and the pencils transacted been 120 times, what's my float rotation? Well, the volume is of 120. Our float, our amount of pencils is 30. So our float rotation would be 4 times, because 120 divided by 30 is 4. Same thing here, 118 million divided by 26 million would give us 4.5. That is a good number. And I noticed that by the time, but in real time, that stock wasn't like this, right? So I was already looking at the fact that number one, this stock opening up at it opened up at, first of all, it opened up at $2 pre-market, went all the way to 5, credible range, and then came back down. But this gave me one thing. It gave me a range. It gives us range. It gives us an area of, okay, we already got there on very light volume, as we see here. Let's see what happens when we introduce some real volume. I think that's the reason that it blew up almost. At the end of the day, it was a total of, let's see, percentage change calculator. I had the number here. So we were at, start off at $2 a share, all the way to 6.86 gives us a 243% increase. This stock reached a peak point of 243%, and I was able to yield a 100% return on my money. Bought at 3, sold at 6. Crazy. I'll get into how I did that. A lot of it actually wasn't skill. It was, you gotta admit where it is. It was, I wouldn't say, maybe it was luck. Yeah, I think it was luck, because the pieces were there, but I didn't know it would reach 6, if that makes sense. The pieces were all there for this stock to blow up. So let's analyze what those pieces were so we can better use them for next time. Number one, we had range. Number one, what's range? We have this whole entire space to work with. Now keep in mind, I'm using the 5-minute chart. I want to use the 5-minute chart. 1-minute chart's too quick, too unpredictable. So we have all this range. So by the time that we enter, right before we open our market, even though this looks really shitty, which it does, we at least have this range. This range exists, okay, which is good. Number two, it's below $10. That's good. Why? Because if we have a lot of range and it's below $10, what does that mean? That look, 2.5, $3, 3.54, it's moving very much and it's very cheap. Meaning that if you had only 100 shares at $3 and you sold at 4, you made $100. And look how small this movement is, right? Compared to GCTS, that has these tinier, you see a tinier distance between 12 and 11 respectively. Now, where was I? So reasons that, okay, number one, we see the volume was incredibly light. Incredibly light, obviously looked big at the pre-market, but as soon as the market opens, this stock, I believe, gets halted right into the market. 1, 2, 3, 4, 5, and 34. Yeah, it got halted. 5 minutes into the open market, it got halted. Now, this was, I started looking at the stock right during the halt. It halted. I'm thinking to myself, okay, let's look at it. It just opened at $2.25. Moved all the way up to $3.2. What's 2.25? All the way to, say, 3.2. So the stock just increased 42% in the matter of 5 minutes. I'm thinking, holy shit, it just did that in a matter of 5 minutes. We have range, it's cheap, we have a low float, right? We have a low supply, low amount of shares in the open market, which is good because a bigger influx of demand will push our stock higher. As opposed to we had a bigger float like the other stock, the first one, it would need even more demand to push it. So we don't even need that much demand. We just need enough demand to push it. This is why the stock is good. Another one is this entire move is already up 42%. You could see in the day it ended 177% positive, but that's at the end of the day. So all right, so where was I? So it halted At this point, I'm down $580. I'm thinking to myself, fuck. Well, this stock looks like it's going to offer good risk to reward rewardability. Let's just throw in 200 shares upon resumption, upon the dip, and we'll wait to see what happens. If it goes from 3 down to 2.8, 2.75, I'll just stop out for my loss and call it a day. So I entered my 200 shares here. Now, at 3. Now, keep in mind that I understood this stock was of high quality. However, my execution on my entry was not good because I kind of just entered it at whatever price it resumed at. It resumed here. I entered at 303. My resumption was perfect on paper, yes, but up here it was not. Because I also entered at just a random, like not a random moment, but as soon as it resumed, whatever, we're in. Which I already knew. I mean, it had all this volume, all the pieces were coming together. I knew this stock had potential. However, there's also risk to it, and a better entry maybe would have been, like, realistically, because this is kind of an anomaly. This stock is kind of not an anomaly, but this is a perfect stock, right? This stock right here is like a perfect day trader stock that we look for, that I trade for, right? But not every day is like this, so we have to prepare to survive, not to win. So a better entry would have been to just enter maybe only 100 shares at resumption and then see how this moves. You see it would come back down, maybe add again here, have some more patience, who knows, but whatever. What's happened has happened. So I entered 200 shares there because I was confident, but it was a very risky move. I held up here, and I held. Thought to myself, okay, if it's going to come back down, I sell off. If not, I hold. And I ended up holding until it moved all the way up to 5 again. Moved all the way to the 5. Huge rejection here. And it halted at this previous pre-market level, right, which is this gray line. Halted there, which makes sense. You see how a previous key level can be used as a halt level. I don't know if that's a coincidence, but I've seen this happen many times where I have a certain pre-market level, and that's where it halts. And I think that's because all the buyers start jumping in to break that pre-market high level. So whatever. They, 5 rejects, comes back down, dances around a little bit. However, it maintains above the VWAP. And look at this gray 9 exponential moving average, which is one of my indicators. It keeps moving forward. It keeps moving upward until it matches here. And then we get an explosion. So that explosion could be due to a multiple factor of things. But we see here, every time it draws back, the next time it draws back, this one has one less candle than the previous one. And this one only has 1 candle. So 3, 2, 1. And the whole time, the whole low areas are moving higher. As we see an upward trends of our supports, as we see here. So whatever, we have our high, it comes back down, supports, dances around, and shoots up, and we can see why it shoots up, right? What I just said, 3, 2, 1, 9 exponential moving average comes in for support. Buyers like to trade off of it, they push it up, and we get our little push back up. Now I had a limit order to sell at 6. Why did I have limit order to sell at 6? I thought to myself, well, hell, like I'm down 580, let me just have my limit order at 6. So there was no actual strategy behind that. And I myself also have to understand that even though today I made a 100% return on my money on a single trade using only 10% of my total buying power, which is also only 50% of my real capital. So I only use 50% of the money in my entire account to yield 100%. So the 50% of my money in my account, that 50% yielded 100%. Let me see if the math is mathing. Right. Yeah, that's math. Okay, so that made sense, and then I just kind of kept trading these highs, and I traded this 1 minute flag, and then I was out for the day. I was done. Now, what the yellow means are what the yellow is are lines that I draw prematurely. Yellow are lines that I draw prematurely, and then I take them off. Red are lines that have some sort of use to me. So we see that this is our channel. This channel, we have resistance, we have support, we could have the supply zones, demand zones, whatever you want to call it. The point is we have key levels we can work off with, and those key levels build off each other. This key level is building off each other because more buyers are buying the support, less selling pressure. Buyers are using that exponential moving average with them. Whatever the case may be, this is a 5-minute flag. We have a 5-minute flag here, and we have a bigger 5-minute flag here. And then we have a small 1-minute flag right here. We have a 1-minute bull flag right here. We have our high, consolidation sideways, shoots up. That's our flag right there. Why do we call it a bull flag? Because it looks like a flag. Like a flag that you hang up, like the American flag. You see we have the pole of a flag here. I'm going to remove this real quick, and I'm going to remove this. We have the pole of the flag, the stem that you would use, and then we have the American flag right here. We have a bull flag, and then again it takes off here, and the flag pattern would continue, but it doesn't. Now this bull flag pattern is basically a faster, a more sped up version, which happens on these low float stocks, of our ABCD pattern. As we see, it's essentially the same thing, only the ABCD is more common seen. Why is it called the ABCD? Well, we have our A, start of the move, the pull, B, high of our move, supply zone of our move, resistance level, whatever you want to call it, because we see this area as resistance. We have our C, which is usually the lowest point, which would be either down here or the lowest point of our consolidation period. Could be around here, maybe here. The point is you want to keep a low that we could use the lowest point, which is where we stop out, or which is where we begin our dip buying to then prepare for the launch back up. And then we have our point D, which would be the break of this previous B level. Simple ABCD, flag, ladder, wah-wah, all that stuff. So, I think I explained why this stock was a great stock. If we keep moving, like, let's hypothetically, if you had 1,000 shares, you bought it at $2,000, sold at 7 shares. You just made $5,000 with only $2,000, right? Yeah, you made a $5,000 profit with only $2,000. Now this is obviously impossible and hyperly unrealistic because you never buy at the lowest point, and you never can sell at the highest point. It's very rarely. I mean, it's very, very rarely. I've only ever been able to sell at high points. Now, I can never call the high points. For example, here, I stopped trading at 1104. At what price? At 6.63 at 1104, which is 1104 right here. Why did I stop? Did I know it was the peak? No. But I'd already amassed all this much gain, a huge move, plus a little extra move, which maybe some FOMO buyers may have missed on. People who are FOMO buying, they want that little extra move, and boom, right there, right? So after that, I was like, all right, I'm gonna stop. So yes, this is why this is a good stock. It's low float. It has, it also, another good thing about stocks is we want to make sure they have news. This one had a catalyst. We want them to have a catalyst. They have to have a reason as to why they're blowing up, right? There has to be a demand. The demand. How do we get the demand? People buying. The catalyst and news outreaches to them. So yeah, this is why this was a good stock. On top of that, this chart pattern just generally just looks much more clean. We just see this much more clean. The only real line I need is right here, because this is the height of my flag, which then becomes, this resistance level becomes support, which means that my trend is bullish. That's a little saying I made up for myself. Somebody probably also created it, whatever. When my resistance becomes support, when my resistance becomes support, my trend is bullish. Not always, but generally. When resistance becomes support, the trend is bullish, as we see this exponential moving average we've been over. So we're gonna remove that. So yeah, this is an A+ quality stock, just the way it looks also, right? Even though GCTS also made some good moves. If we put them side by side now, and I chose you which one, if I told you which one of them was going to happen, you had to choose, you would most likely choose this one. It's just much more even. All right, we could first analyze the open market, right? Let's just see how it looks on the open market. GCTS, okay, maybe some predictable levels, but which you could trade. You could have probably have shorted it off the. Maybe you could have shorted it off the VWAP. That is true. Let's open it up a little bit so we can see the volume bars. Okay. Well, yeah. Well, here's the thing. This maintains a more consistent 5 million share volume per 5-minute candle, as opposed to this. Why? Because it was maybe it already moved too high. I don't know. I don't have the answer for that. I don't know why the volume was less on this stock. Maybe just a huge move downward just exhausted the buyers. But the point is, looking at the beginning of this move, as opposed to this move, I would like to be in this flag. Now, some shorting traders would rather be in this move. This, I always thought shorting off the VWAP was the most simple strategy I've ever saw. Stock short, stock drops in the middle, comes back to the VWAP with a VWAP tap, and then again just goes down again. That's the most simple strategy I've ever read. Why don't I do it? I don't like shorting. I like this better. But I will eventually get into it. But even this pre-market, I mean, if we consider the movement that they went up this, I would take this over this because this shot up straight, came back up and rejected. This shot up straight, pew, keeps going up. So yeah, a lot of analyzing, a lot of things to go over, a lot of things to study. However, I don't know if I would call today a good day, but it's definitely a surviving experience, and that is my goal. I cannot repeat the same mistakes which I had with GCTS, which was to over leverage on a stock that is too volatile. Like that cannot happen again because next time I don't know if I will be able to survive. So we must be able to be in a position where we could survive any outcome. If the majority of shares I was able to put, because this broker doesn't allow a margin above stocks that are $5, so it didn't allow any margin. So the max amount of shares I could buy was 200, because I'd already taken a huge $600 loss at the beginning, right? So it took away 50% of my buying power, if that makes sense. So it's now I have my buying power. Now I have my full account back because I was able to remake that money. But I cannot afford another failure like that. Failure myself. Cannot afford that, and I will not. So yeah, so outcome for next week again will be survive, get some profits. This entire week my risk management was on point except today when the stock was volatile. Today put me to the test, and I survived. And I will keep on surviving until I start turning a profit. That is what I will do. Anyways, this is Kevin. This is Kev from Tavera Trading coming at you from Friday night, evening, buena noche recap. Enjoy your weekend, and I will see you Monday.